Hey, Johan.
Hi, Shannon. How are you?
I'm good. I'm still thinking about how much fun we had putting together our last episode on Creditas and what they're building in Brazil and Mexico. I'm so glad we were able to do a deep dive into that one.
So are you finally going to give me credit then for being the best co-host you've ever recorded with?
You are. You are the best, and also maybe the only podcast co-host that I've recorded with, but you are definitely the best.
Fair enough. Thanks. What's on your mind, Shannon? What's going on?
Well, so there's a few parts of our conversation with Fabio Zveibil, the VP of Auto and Home Secured Lending at Creditas, that I wish we could have shared in our last episode, but we were getting a little long. But we touched on how Brazil got into a place where credit was so expensive in the first place.
That's great. How about we share them right now?
Let's get to it. Can you explain how credit becomes toxic debt and what this means for borrowers in Brazil?
Sure. So toxic debt is basically something that's very expensive and something that you cannot get out of. So that's pretty common here in Brazil with the high interest rates of some of the products that people use on a regular basis. And they kind of get trapped in a cycle they can't get out of, something that takes a pretty big chunk of their family incomes, and they're locked into that and need help to get out of the cycle.
Can you give me sort of an anecdotal example of how someone might enter into a toxic debt agreement, what they do, and then what the outcome is, what that looks like for them in their real daily financial lives?
Yes, it could be a credit card and they got a higher limit on the credit card and thought that was income and used that as an extra income in a month. And from that moment on, they just had to pay down the installments or get into revolving, or they could do that with point of sale financing, like buy now, pay later. They're always paying installments on something that they buy. They're always behind on those installments. And that, again, creates a vicious cycle.
So before Creditas came along, what credit sources were available to Brazilians?
Short-term, high-interest rate products that are pretty easy to get, either at a bank or other institutions. It could be retail, it could be small financing players. The asset-backed are there, especially for acquiring goods, right? So home financing is there, car financing is there. But the penetration is much lower than developed markets because people are just afraid to take out a long-term loan. They prefer to pay down very quickly or to save before acquiring. Mm-hmm. And you should not do that for a house, right? Because you're going to save on that interest payment on your house, but at the same time, you're going to be on overdraft or you're going to be, revolving your credit cards. It's not a smart financial decision, but it's kind of a subjective belief that people have that they don't want to have debt, and they don't understand that other things that they buy in installments, they buy over time, are actually debt.
Right.
They're just, interest rates are kind of hidden, right?
It's still debt. Yeah.
So definitely people want to achieve those goals. Buying a house, buying a car, depends on where you come from. They're very aspirational, and people get there and celebrate. I remember when my father bought our first apartment, and of course he financed, but when he got a bonus at work, he would immediately go there and pay down some of the debt because you don't want to be locked into a long-term debt. So people do want to have homes and cars. There are over 100 million homes in Brazil. There are over 60 million cars in Brazil. So people do have those assets. But yeah, it's a aspirational things to achieve. People are reluctant to borrow against that. Different from other places, that's pretty common, right? So you build wealth, and that wealth allows you to do other stuff, borrow against that. And that's something that we're trying to break, that belief that it's wrong to leverage your house or leverage your car or leverage your salary to get a better loan, especially when we tell people compared to the alternative, right? You're either not going to do something they want to do, or you're going to get a worse product in the market. So that's a very complex process, education, and even explaining to a customer at the point of sale, trying to convince them to take out the loan.
Yeah.
That's much better than the alternative they're considering.
So interesting how you go from sort of a bricks and mortar model where if you have a lot of defaults, you have to price that into everybody, right? If you're a big bank and you have a lot of defaults, like that's the number one thing you're pricing in above and beyond the cost of funds that you're lending. But in your case, so different to serve digitally and to be digitally accessible for servicing, and just the asset-based component of it, I think is really a wonderful way to reinforce really positive credit behaviors. Is that how you guys would describe it or how you see it? You see it sort of net, you're really teaching people how to use credit effectively, aren't you?
Yeah, so we employ a combination of technology and consultants, experts to talk to the customers. So we want the customer experience to be as easy, frictionless as possible, but they actually want to talk. They're putting their car or their houses as collateral to a transaction. And even though we allow them to do that, the whole process automatically, we collect data from different places for them. We collect documents. They actually feel the need to talk to someone to explain how the product works, explain if they can lose their asset or not. And it does happen, but it's much less than people think. So that's a mismatch here in perception and reality. Everyone thinks they're going to lose their house, but actually only a very, very, very small percentage of the customers actually lose their house in the product. So you should not need to worry that much. But how do you explain that to someone, right? So the combination of technology and the assistance of experts both help educate people, but also help lower the cost. And when we lower the cost of transaction, we can pass that over to the pricing, and the price is more competitive, and then it's a positive cycle, different from the negative cycle when people are stuck in a revolving line of a toxic lending product.
All right, final question. As a native Brazilian, what is your dream for how credit should work in Brazil? What is the best case scenario that you guys want to see out of Creditas and the way that it's revolutionizing credit access in Brazil?
Credit is the engine of the economy, right? People need credit to consume, to build businesses, to progress in life. And we think we can multiply the amount of credit in the market by 5 times, 10 times, just by having better lending products. So people are going to pay the same every month, but they're going to get 5, 10, 20 times more money than they get today just because they're using the right product. So the car is there, the house is there, it's sitting, it doesn't have any debt. Why are you taking a revolving credit line? We think with better products, lower cost structure, and financial education, we can help develop the credit market, and that's going to be good for everyone. Everyone's going to consume more, everyone's going to invest more, and then the economy grows.
I love it. Big fan.
Mm-hmm.
Fabio, it's been fantastic talking to you. I really appreciate your time. That was Fabio Zveibil, the VP of Auto and Home Secured Lending at Creditas.
Thanks, Shannon. We'll be back in 2 weeks with another great story about global finance. Follow the $1 trillion opportunity on Apple Podcasts, Spotify, iHeartRadio, or wherever you listen to podcasts.
The $1 Trillion Opportunity is produced by Quona and Pod People. Our producers are Danielle Roth and Hannah Pedersen. David DeLuca edits the show. Special thanks to Rachel King and Amy Machado.